All right, let's talk about something that could seriously change the game for your business finances. We're going to break down one of the most powerful tax breaks out there for small businesses and side hustles, one that could save you a ton of money.
So, if you're out there freelancing, running an Etsy shop, driving for Uber, or building any kind of small business right here in the United States, then you need to listen up. This one is for you. And I mean, who doesn't, right? We're about to dive into a special deduction that could put a very real amount of cash right back into your pocket when it's time to file your taxes. Here it is, the big number, 20%. Let that sink in for a second. This is the heart of what's called the Qualified Business Income Deduction, or QBI for short. And trust me, it's a pretty big deal.
So what is this 20% tax break really? Let's pull back the curtain and break down what it actually means in plain English.
Basically, the QBI deduction is a federal tax break that lets you, as a business owner, potentially chop off up to 20% of your business profit before you even calculate your taxes. And a huge piece of news is that it was made permanent for 2026 and beyond.
Now, the key here is that this is specifically for what are called pass-through businesses. That's just a fancy way of saying your business profits aren't taxed separately. Instead, the income just passes through to you, and you report it all on your personal tax return, your Form 1040. This covers most small business structures like sole proprietorships, partnerships, S-corps, and the majority of LLCs.
Okay, so this is the part you've been waiting for, the moment of truth. Does this amazing tax break actually apply to you? Let's figure out who really qualifies.
So there are basically 4 big boxes you need to check. 1, you have to have something called qualified business income. We'll get to that in a sec. 2, your business has to be based in the US. 3, you have to materially participate, which is just the IRS's way of saying you're hands-on and actively running the thing. Think putting in over 500 hours a year. And 4, things are a lot simpler if your total income falls below certain limits.
So what exactly is this qualified business income, or QBI? Well, think of it as the net profit from your active business. It's the money you make from your freelance writing, your Etsy sales, your consulting gigs. What it's not is the salary from your day job, your W-2, or any passive income like interest or dividends.
And speaking of limits, here are those income thresholds for 2026. Here's the key. If your total taxable income is below these numbers, getting that full 20% deduction is usually pretty straightforward. If you're in that phase-out range or above it, things can get a little more complicated, but you still might be able to get at least a partial deduction. Oh, and a quick heads up for certain professionals. If you run what the IRS calls a specified service, trade, or business, like a doctor, lawyer, or certain types of consultants, and your income is above those thresholds we just saw, there are some extra rules and limitations that can kick in. It's just something to be aware of. Now check this out. This is a pretty cool new feature for 2026. Even if some of those other limitations try to reduce your deduction, as long as you've got at least $1,000 in business profit and you're actively participating, you're guaranteed a minimum deduction of $400. It's like a nice little safety net.
Okay, we've talked about the what and the who. Now for the really fun part, the why. Let's get down to the bottom line and see how much actual cash this can put back in your wallet. Because, talking about rules is one thing, but seeing the numbers in action, that's what makes it real. So let's walk through a super simple example.
Okay, let's imagine your side hustle. Maybe you do freelance graphic design. Brought in a solid profit of $50,000 this year. That 50 grand? That's your qualified business income.
Now for the fun part. We apply that 20% rule. So 20% of that $50,000 profit is a cool $10,000. That is the amount you get to deduct from your income.
So what does that 10 grand deduction actually mean for your bank account? Well, it could easily translate to about $2,200 in actual tax savings, assuming you're in the 22% federal tax bracket. That's real money that stays with you instead of going to the IRS.
And this is a super important point to understand. The QBI deduction doesn't work like a tax credit that reduces your final tax bill. Instead, it works earlier in the process. It lowers your taxable income, so the amount of your money that even gets taxed is smaller from the very beginning. I know what you might be thinking. This sounds awesome, but it's probably a nightmare of paperwork, right? Well, let's walk through how you claim it because it's probably way more manageable than you think.
It really just comes down to 3 steps. You calculate the deduction, usually on a form called 8995. Then you report that number on your main Form 1040. And of course, you keep good records to back everything up. But honestly, the best part is that if you use any decent tax software, it does pretty much all of this for you. Okay, to wrap things up, let's not just talk about getting the deduction, let's talk about getting the absolute most out of it. Here's a simple little action plan for you.
These 3 habits will make a massive difference. First, track every single dollar in and out. Your QBI is based on your profit, so good bookkeeping is everything. Second, keep a simple log of the hours you work. It makes proving you participate a breeze. And third, please don't wait until tax time. Run some numbers mid-year so you know where you're headed.
So I'll leave you with this question. If you could save, say, a couple $1,000s on your taxes next year, what would you do with it?